let's think about the impact of government intervention in a perfectly competitive market. The kinds of government intervention that we're going to be looking at are price controls and taxes. With respect to price controls, we mean that the government sets a legal price above or below the equilibrium price. And a tax is simply an amount of money that either is imposed officially on suppliers or consumers of a particular product. We know from our previous studies that in the case of a perfectly competitive market, which has no kinds of imperfections in it of any kind, such as externalities, that left to its own devices, so to speak, the perfectly competitive market will yield an equilibrium price and quantity such that the marginal social benefit of the last unit consumed will equal the marginal social cost of that last unit which is produced. And therefore we can say that the market is generating an allocatively efficient outcome. And in that case, we also know that this will maximize total economic welfare. That is to say, when we add the consumer surplus to the producer surplus, we get, in graphical terms, an area which is as large as possible given the curves, ceteris paribus. There is no deadweight loss of economic welfare. Now, what we're going to see is that if we deviate in any way from that equilibrium, then a deadweight loss of economic welfare will be generated. So if price controls are imposed, which deviate from the equilibrium price, then a deadweight loss will be created. If the government imposes taxes that manipulate either the demand curve or the supply curve, again, it will generate a deadweight loss of economic welfare. So it would seem, on the face of it, that there's a kind of ideological message that comes from this. That is, free, unregulated markets that are not manipulated in any way by government pricing policies or taxes, would be preferred to, better than, in economic terms, markets which were manipulated in such a way. That is, we would say that markets which governments monkey around with will be allocatively inefficient and will not maximize economic welfare. Therefore, government should not seek to intervene or manipulate such markets. We need to bear in mind, however, that this, within the mainstream theory, would only hold true if we are talking about perfectly competitive markets in which there are no imperfections of any kind. In particular, there are no externalities of any kind. But we also know that that's not really a very common state of affairs in reality. And even if we did have a perfectly competitive market that had no imperfections in it of any kind, it doesn't necessarily follow, normatively speaking, that therefore government should not intervene in any way. It might be the case that the society has different ethical principles to those informed by the criterion of allocative efficiency. We could, for example, imagine a perfectly competitive market. Of course, it wouldn't necessarily exist in reality, but we can imagine a perfectly competitive market which we might find ethically unacceptable. We might say talk about a perfectly competitive market for slave children, for example. We could say that the market will find its equilibrium, consumer and producer surplus will be maximised, there will be an allocatively efficient allocation of resources, maximum economic welfare, no deadweight loss, and therefore we would have a situation where government should not intervene. Maybe not. Maybe we have a different criterion which says that children should not be bought and sold as commodities, in which case, if we held to that criterion, we would just shut down the market altogether, rather than adhering to the criterion of allocative efficiency. In any case, let's get on with the show.